Welcome, everybody. Apologies, we're a couple of minutes late, just a minor technical issue. All sorted now. So it's good to end this week of our month-long series of presentations with the world's preeminent stock market, and we have one of the preeminent investment trusts that invests into that stock market today. I'm sure there'll be lots of questions about what's going on in markets. I'm very pleased that we have Fiona Harris from JPMorgan. She is the font of all knowledge about this strategy, and she's going to talk for perhaps 20 minutes or so, maybe a bit longer, about the trust and the outlook, and then there's time for questions afterwards. For those of you who are new, you'll see in the bottom right hand corner of your screen it says Q&A. If you click on that, you can type your questions in. I can read those, and we'll have a chance to talk about some of those at the end. And with that, I'll hand over to Fiona.
Thanks, Alan, and thanks everyone for joining us. And apologies, the difficulties were on my side. I'm actually joining you from New York, where would hope things would work smoothly, but testing it out in the office this morning, it didn't. So apologies for the slight delay at the start. For those of you not familiar, JPMorgan American Investment Trust, or JAM as we like to call it, has been around since 1881. So clearly we're doing something right when we think about the investments landscape and investing in the US. I'm part of the US equities team at JPMorgan, and I'm delighted you could spend the time with us today to learn a little bit more about JAM. So we go to the first slide. For me, there's a couple of things that I really, really like about JAM, and I consider it a sweet spot. One, because the largest allocation within the portfolio, over 90%, is a concentrated portfolio of 40 stocks. And the reason I like concentration is it takes a new degree of management insight. You have to have real confidence in the names you're investing in to hold a 40 stock portfolio. And so you've got the best insights in those 40 names. The other part, the middle part, is it's a combination of value and growth. This is a core portfolio. The benchmark is the S&P 500. But it is the best ideas from value and the best ideas from growth to get to core. So you don't need to think about styles. Value is working right now, growth not so much. Growth worked last year, value not so much. For us, it's about having the best ideas in this portfolio, not about which style is going to work in the marketplace. And that's really important because we've seen times, even when growth has done really well, some of our top contribution names have been from the value side. So having that balance of the best ideas from growth and value means it's an all-weather style portfolio. You're not tilting for styles or running for styles. And the third element, it's got flexibility. As I mentioned, the largest part of the allocation in JAM is a large cap portfolio of 40 stocks, but we've other levers to pull as well. We have a small cap allocation. So when you ever look at the holdings, you'll see a long tail. So 40 stocks make up the bulk. The long tail is a small cap allocation. And again, it's legacy in terms of the portfolio itself. It's a really nice to have because they're the blue chip stocks of tomorrow. You know, when these companies IPO, the IPO is a small cap name, Amazon, Tesla, right? And then they grow into those big, large cap names. So it's nice to have exposure to the blue chips of tomorrow as well. That allocation today is around 6%, maximum 10%. And of course, the beauty of trusts is gearing. And so having those levers that we can pull is really important. So if you turn to the next slide, it gives you some sense of that allocation. And I've just highlighted the latest one here on the left-hand side. You know, over 90% is that large cap, concentrated 40 stock, value and growth. We then have that small cap allocation at around 6%. And it's increased a little bit as we think some of that opportunity set is ripe for a lot of these companies with good earnings growth. And that's the key to small caps and sustained momentum in small caps. The key at the end of the day is earnings. And we say the same for large caps. And then, of course, you look at the gearing, and we've got about 6% geared right now. So it's a nice balance within the overall portfolio. We are very experienced investors, and that's why we can collect these different elements to bring you this portfolio today. And think of it like an all-weather or one-stop shop. You've got small cap, you've got value, you've got growth. You're benchmarked to the S&P 500, so you don't need to think about the other asset classes. And we've got that expertise. If we turn to the next slide, this is just our US equity portfolio managers, not the research analysts. These are the people who manage money for us at JPMorgan, and they manage over 900 billion. And the US is our home market, and we've got different styles, different desks, right? Small cap team, mid cap team, large cap team, growth team, value team. And I've highlighted here the people that actually work on JAM on a daily basis. Purple are the value team. Jack Caffrey is the lead value PM for us on the large cap element. And above him is Felice Agranoff. She's the lead PM on the growth part on the large cap end, but they're assisted with the small cap PMs for that small cap allocation. Larry Playford on the value side and Eitan Shapiro on the growth side. And these are very experienced individuals. And they've been through multiple market cycles. And we will take a moment towards the end of the presentation to talk a little bit about these markets right now, because the marketer is always giving us information. It's always weighing news. And so it's a very different market today than it was last year. But we're long-term focused, right? And these PMs don't do it alone. It's not just these PMs working on your behalf in terms of supporting JAM. If you turn to the next page, this is our broad-based team of US equity research analysts. And they sit on the same floor that I'm sitting on today in our New York office. And they all work together. So we've got deep expertise on the PM side, investing through multiple market cycles, but they don't do it alone. We've got a deep bench of research analysts. And that's really important every day. But when you're in the midst of what's happening right now, particularly in relation to AI, as the market's trying to navigate these companies who had big CapEx spending, well above expectations, but are now actually seeing cash flows come way down, they're having to finance a lot of this from debt. That's a change in the dynamic that the market's causing to shift. But it's great because our industrials analysts can talk to our technology analysts, who can talk to our utilities analyst and paint the mosaic of what's happening within this dynamic, and then talk to our financial services analyst, what's happening with the banks and lending and capital markets as well. And so working together in collaboration is really, really important. And so this is a team-based sport. And so if we turn to the next slide, maybe just talking a little bit more what we're looking for on the large cap end of the portfolio. I think the key word for me is quality. Nobody sets out to buy poor quality businesses, but it's how you define quality is really, really important. And that's why our value and growth teams work so well together, because the core tenets of their investment process is the same. They're both long-term investors. We're thinking about investments for 3 to 5 years. We're looking at quality companies with good cash flows, good earnings, good margins, good management teams. And on the value side, which you can see in the purple with Jack Caffrey as the lead, assisted by Graham Spence, they're really looking for companies who are trading at a discount to their intrinsic value, whatever that reason may be. And right now, we're seeing a lot of opportunity in healthcare. It's been a forgotten sector. It's a sector that has underperformed the market for a number of years, and particularly forgotten unless you had a GLP-1 drug. But there's some great names there in that space, and we can take advantage of that. And we can lean a little bit into that expertise. On the growth side, well, we're really looking for companies, those high quality companies with great management teams, great earnings, great cash flows, but where we feel the market's underappreciating their growth potential. So we're not buying market expectations. We're buying our fundamental research on expectations. And so because of that deep commitment to fundamental research, we have about 4 company meetings a day. All right, we've got over 2,000 companies that we visit per annum. It's a big undertaking. It's a big commitment, and one we spend 190 million on per annum. And we believe in fundamental research. And that's the really the building block is looking for those great companies, but on the value side, looking for them when they're trading at a discount to intrinsic value, and a growth side, looking when they've got underappreciated growth. And so we don't just look in tech for growth names. You'll see a lot of industrial names, companies like 3M, which we hold on the growth side because we don't think the market's appreciating their growth rate. They're anchored in the legacy of this building, of this company, which actually was really bad at capital allocation, right? But they were seeing organic growth. They've streamlined their businesses, and nobody's given them credit for that. So having a deep bench of research analysts means the PMs can dig deep across the marketplace to find the best ideas for inclusion in this portfolio, to give you that really that all-encompassing one for the whole market. And so, as we said, it's 40 stocks, but we can tilt a little bit. If you're reading the final characteristics on the bottom, we can tilt between value and growth. And that's not style driven. That's more risk management. Because if growth's doing really, really well, we're probably trimming and taking profits, recycling that cash into names that aren't working, that we still have confidence in. But at the end of the day, at some period, you don't want to put more money to work there. Chances are it'll go to the value team. And for most of last year, we were overweight growth in this portfolio, underweight value. And today we're about 50-50. At the start and towards the end of January, we started taking more money off growth because we got worried about the earnings growth expectations, but also the funding of CapEx because it wasn't coming from free cash flow anymore. And again, the market has recognized that and trying to decipher the next move forward in these names. So that gives you a little bit idea in terms of what we look for companies. If we turn to the next slide, in terms of where those ideas come from, really it comes from our research analysts. As I said, they do a huge amount of meetings every single day. And it really is their best ideas working with the PMs for inclusion in the portfolio. As I said, for value side of it and growth side, we're very fundamentally driven. We're looking for high quality companies, great management teams. But on the value side, we're looking for companies that trade at a discount to their intrinsic value. And on the growth side, ones that have underappreciated growth. But for portfolio construction, really position size, it's really driven by our confidence in the quality of the business. And really the diversification. We have to manage risk very carefully in a 40 stock portfolio. So we're not going to own 2 hotel stocks. We're not going to own 2 rail lines. We have to think about diversification. So managing risk is critical in all portfolios, but it's an extra lens you have to put on it in a concentrated portfolio. Also, our stock and sector constraints means there's very few names we have to hold in the benchmark, which is really important. This cannot be a best ideas 40 stock portfolio, but hey, we have to hold this name because it's big in the benchmark. So what you're getting is true reflection of our risk management, but really at the end of the day, our confidence in these names. So we turn to the next slide, just to give you an idea of some of these names. If we just skip this, if that's okay, just to give you some ideas of the names. It's a 40 stock portfolio. These are probably not household names for you. You may have seen Ecolab vans around, or their cleaning products in places. And this is one of our favorite names in the value space. So what Ecolabs do, it's really, when you think about it, it is pest control and cleaning products, right? On a commercial sense. And their business is over-earned during COVID, and it caused them a long time to reset, right? Because if you think about cleaning products and the need for all of that during COVID, and the business has reset, but its huge volume is recurring revenue. And that's something we like. It's like a toll collector, always getting paid. And their model is very simple when they come into companies. They will tell the management team, and they'll prove it. For every dollar that you spend with them, they will save you a future dollar. Because if you've got pest control or cleaning issues, you want to make sure it's taken care of. And they do really, really well. It's got a great management team. They've got longevity and experience. And that's a good culture. That's really important in terms of the culture of the management team and the business itself. And they've seen really good dividend growth as well. They've used a lot of the cash flow in terms of making tuck-in acquisitions. but a huge amount is that consistency of earnings. So think about that like a toll collector, as I said. And so they're seeing huge improvements in a lot of the initiatives they've undertaken. And for us, that feels more like a consumer staples company, even though it doesn't fit in that space, right? Really good at execution, really good at what they do. And that's on the value side. On the growth side, probably a name, Quanta Services, is one again that you're probably less familiar with. Quanta Services is an industrial company who are in power management, in particular, really helping with the upgrade of the grid. We have rolling blackouts and brownouts in the US. We've underinvested in electricity grid for too long. We needed to improve it. But not only did we need to improve it, we've also got data center growth and everything else. And Quanta Services is the only company in the States whose labor force are actually certified to work with live power lines. So if you're upgrading the grid, adding more capacity, this is the only company that's certified to work with those live power lines. And so as we think about the need to really upgrade the grid and also add more in terms of capacity and supply, as we all need more and more electricity, this is a company that solves that. But they're really smart about what they do. They actually bought a university a number of years ago, so they train their own electricians. So they've got their pick of the labor force coming into the marketplace as well. And again, thinking about that supply of labor is critical for them and what they do. And so when we think about, again, the breadth of the country in the States and large transmission lines, they've got over 60% market share. Like that's a huge market share. That's really important. And when we see that grid really expanding over the next few years, and we think it's 50% or more expansion over the next few years, this is really important in terms of what they do. It's mission critical. They've got a long backlog of projects that they're working on, and it's great execution. Now, we all have to be careful because it does have some AI exposure, because some of that need for electricity and demand is driven by data center needs as well. So again, we have to recognize some of that AI within this company as well. It's not the only criteria, and in fact, it's one of the reasons we bought this company long ago, before actually data centers became such a big driver of this market. It was really because of that upgrade of the grids that we need. And so our utilities analyst works with our industrials analyst, works with our technology analysts to try and determine what that demand will look like, and so that we can project that out and see what's happening. And again, who wins and why. And one of those winners we feel very strongly is Quanta Services. So that's an example of a name in the value side, Ecolabs on the left, Quanta Services on the right. And again, we're agnostic which PM holds these names, because our PMs are paid on overall performance of the portfolio, not their individual stock picks. And that's really important, because sometimes it can be really hard to determine, is this name a value name or is this next name a growth name? And if we turn to the next slide, we can give you that lens of the overall portfolio. The names in green are our growth names. These are the 40 stocks in the portfolio at the end of February. And in purple are the value names. And we could debate it. Is Apple a growth name or a value name? We don't mind as long as it's the right name in this portfolio. And that makes an awful lot of sense for us. But as I said, some of the things that you'll notice is our biggest number of names is in the technology sector. It's our biggest allocation overall, but it's also our biggest underweight. And here we're managing risk. And that for us is really, really important. We've been trimming a lot from Microsoft. We've been trimming a lot from the names that have done very, very well. We've been underweight technology all of last year. It hurt us because we had these AI memes and themes playing out in the marketplace. But for us, it's looking at that underappreciated growth potential. We're finding better ideas elsewhere. And so, again, we're taking some of that risk off the table in technology, and we've been able to add names like Netflix. Netflix is a name where I'm sure most of you use that product and that service. And again, for us, it's been really, really important in terms of finding those great ideas, that great franchise that we don't think the marketplace is fully appreciating. The investments they're making, the revenues they're getting, the must-see programs. And of course, how we consume media has changed considerably over the last few years in terms of streaming, wanting it when we choose, rather than waiting for TV programs to come on at the end of the day. And so we can find different ideas with that underappreciated growth. You'll also see healthcare in the middle, where we've got a slight overweight. HCA Healthcare is actually a hospital franchise. They have their own university of training nurses. Again, making sure they've got that labor supply as well, because we know labor is going to be tight, and we know you're not going to get visas for those coming into the country as easily as you used to previously. So it's really important you've got that labor force for your hospitals to work well. And so again, companies who are making the investment for the future as well, balanced with names like Gilead or Johnson & Johnson within the healthcare space. And if we look on the right-hand side, I did say Staples was an underweight. We have Procter & Gamble, but we, as I mentioned, we feel we've got some of that compensated by positions in companies like McDonald's, where a third of Americans eat at McDonald's every single week. And they had their troubles with their, same-store sales. They put in their $5 menu. That's really attracted a lot of people back to the stores as well. So again, companies that are dynamic, recognizing the environment they're in, being able to adapt, these companies have that potential. And that for us is really, really important when we're looking at these names. One area just to focus on, given everything that's happening this year, is energy. We have two names within the portfolio, Kinder Morgan and ExxonMobil. Kinder Morgan is like it's a pipeline, the largest pipeline for gas and oil in the States. So again, a company that's like a toll collector. It's not about the price of oil or gas for them. It's the volume being moved. And there's huge volumes being moved. And so they get that revenues all the time. ExxonMobil to us is underappreciated. Again, they're a lower cost oil producer. They're doing an awful lot in terms of new initiatives, in terms of carbon capture and everything else. And so again, it's a company that's looking to the future and how they can grow as well. So again, for us, ExxonMobil, Kinder Morgan, it's not about the price of oil, because starting this year, we had an oversupply of oil. We did not expect the price of oil to go up. It has gone up because of the conflict. Again, we feel that's probably temporary in nature as the supplies come back in to the marketplace, but it's definitely one we're watching. But we're not chasing after higher price oil, right? We want companies that can earn well irrespective of where the price of oil is, because we want to own these names for the long term. And that for us is really, really important. And to the left of energy is industrials. We've seen, and industrials has been a unique sector in the last 12 months. It's definitely been an era of haves and have-nots. If you're an industrial company like Qantas that's been tied to AI and expectations in AI, you've done very, very well. But if you're the other part of the marketplace, like a 3M, like a railroad, you haven't done as well. And so we think that there's a lot of opportunity here in this marketplace in terms of companies and names as well. And so when we look at the names that we have, they're very diversified. So think about managing risk, not just with cross industries, but within industries as well. And so we've got that exposure with Quanta Services. We also have comfort systems, similar to Train, which we've owned previously, but just the valuation was a little bit higher. Comfort does HVAC systems, but plumbing, lots of stuff, supplies into data centers and companies in general. And so lots of levers that they can pull on that end as well. And so again, a nice mix in terms of that diversification. And then if we look in terms of communication services, we do have Alphabet, we do have Meta, Take-Two, which is gaming as well. And of course, if you are a gamer, I know somebody who is a gamer, there's real commitment to the games that they have in terms of the marketplace. And then in discretionary, again, nice diversification, companies like Booking. So if you want to book your holiday, your rental car, your airline ticket, again, they help with all of that. And again, it's a capital light business, lots of data, using AI, getting smarter what they want to do, really, really helping them. So that just gives you a lens of some of the names within the portfolio, where we've got those overweights and underweights, but it's all driven from the bottom up. But we're conscious of the risk that we have, so we're trying to manage it well in terms of those stock specifics. And just if we turn to the next slide, just to give you in terms of performance, I mean, this is a very large trust. It's over 2 billion in AUM. We struggled a little bit, if you look at the calendar year last year, being underweight. Technology hurt us there, and some of the names that did very well, but also we made some mistakes. We owned United Healthcare. We don't hold it anymore in this portfolio, and that hurt us in terms of. But we're actually, coming out from 2 very strong years of outperformance, so it's no surprise some of our names gave a little bit back. This year, as we said, having that balance within the portfolio has been very helpful. We've outperformed in February, but we're also outperforming year to date. And this is net of fees in terms of the NAV. So again, having that balance, we don't know when this market will turn on a style or on a stock, but having that balance for us at the end of the day is really, really important. And that's what's coming through this year very, very clearly in a market that the best performing sectors are things like energy. The Magnificent Seven have been sold off in this marketplace. And so the market is telling us something. It's worried and concerned about the amount of capex. Because if we think about cycles of capex spending previously in the history of the markets, there's always been winners and losers, and it takes time for the market to adjust. And so the market is in that period of adjustment right now, looking at where the earnings came from, where that future earnings coming from. We still, this economy that grows, we still think we've got good earnings in this marketplace, but the leadership for this year will probably be different than the leadership from last year. And so having that broad-based balanced portfolio, we feel will add significant value this year. And I think that's really, really important because the areas that really will work this year could be different. We do expect a broadening out of earnings. So the 493, the forgotten ones from last year, should have a higher contribution of earnings as we go through this year, which brings us back and leaning into that balanced approach as well. And so if we turn to the next slide in terms of just summarizing overall, I think, we've got this great opportunity. We've got the best ideas from value and growth to create a balanced portfolio, a core portfolio with the majority of that allocation to that large cap end. We've also got flexibility on small cap, flexibility on gearing when those opportunities arise, which I think are really, really important. But the anchor is still that large cap portfolio with a degree of flexibility. And as I said, it's balanced with a focus on quality. And I think when we look to that earnings, that's what makes sense to us over the long term. Owning quality companies that can add value over the long term. They may not add value 1 month or 1 quarter, but over that long term, over that 3 to 5 years, they can add value. So with that, I'm just going to move to the next slide and happy to open it up to any questions that you may have.
Thanks, Fiona. I don't know about you, but in my career, I've always found it very difficult to define what normal market conditions are, and much easier to define what not normal market conditions are. And I think it's probably fair to say these aren't normal market conditions. So can you just start by painting a picture of what happens? You've got this vast resource of analysts and other researchers behind the team. Can you just paint us a picture of what happens when a big event starts to unfold, how the team responds to that? And then it's not going to surprise you that there are specific questions about oil and implications of what's going on. And I think it's only fair to say your team and everyone else is adapting on a minute by minute basis. So it may be that conclusions are hard to draw, but perhaps there might be some lessons from previous energy shocks, and perhaps now you're having conversations with companies where they are starting to react. So do you just want to talk about the sort of how the team reacts to events like this and what they've learned so far?
Yeah, and it is really, really important. You learn from experience, right? And we're a very experienced team. So one of the first things we do is we look at the implications for any specific stock. So you're going to have market reaction to stock specifics. You need to know if that reaction to a stock is a buying opportunity or is it a selling opportunity, right? Because maybe the stock has risen, but there's nothing showing in the earnings, right? So market's selling something and buying something else, right? And they've been buying energy at the expense of most other things. So is that an opportunity to trim some of our energy exposure if it's risen too highly? That's really important. The other part is to look at this relative to history. We've a deep bench of experience, but we've also got great strategists that we can lean into as well. And when we look at this versus history, the one major difference is the US is oil independent, right? We're actually a net exporter. But it is higher at the pumps, right? And that's really important for the consumer. So one, we're more insulated than a lot of European countries or other countries around the world because we are oil independent. So that's important, but it's higher at the pumps. So for the consumer who's moving into summer season, it's spring break right now. So you're starting to move into that, that period of time where, as we know, Americans buy gas guzzlers and filling them up and then driving over the summer period is going to be, if oil stays higher, a lot more expensive at the pump for them. So for those that got tax refund, some of that tax refund, well, it's nearly all Americans, may have to be offset by that higher price that they're paying for oil. And again, that's really important that we monitor what's happening with the consumer because we're a consumption-led economy, right? And it's all about that consumer confidence and how they feel. And right now, the consumer is still willing to spend, but they're selective in their spending, right? And the other thing that weighs on the consumer, it's not just oil, but jobs, right? And we've had some announcements of job losses. But we're not seeing a huge amount. They're being absorbed by the economy to a certain extent, but we're also not seeing a huge amount of job gains. We seem to be in this holding pattern, right, with everything going on. So I think with that, I think this conflict also is going to create some degree of concern as well, where there had already been concern about AI and what it does to the future in terms of the jobs landscape and how that changes as well. We've seen some software engineers come out of university, less hiring there, right? And on that end of it, as companies try and navigate what this future actually does look like with both AI, but now also with this conflict as well. And layer on that, we've got a midterm election coming in November. So one, we did think there would be a degree of volatility in the market this year. We just didn't think it would come from a conflict in that regard. And so I think in regards to oil, the conflict and everything else, the market's pricing in a few weeks of a conflict and they're pricing in no boots on the ground. That's what it seems like when we talk to people. And they're more experts than we are. If this escalates and has longevity, then we'll probably see another reaction from this market. Because remember, at the end of the day, the market's a weighing machine and it doesn't like to be surprised. Whether that information is good for the markets long term or bad for the markets long term, the market's initial reaction is usually one of a sell-off as it tries to weigh what's happening. And right now, if you look at the market relative to other things, it's weighing up what's happening. And it's trying to decipher where it goes from here. But it's weighing in the expectation that this is weeks, not months. And this is more of a tactical conflict than it is boots on the ground. If that changes, then I think this market dynamic changes. Do we make changes to our portfolio? No, because we base this on fundamentals, not a top-down view. We can all have a top-down view. That's really important. But right now, this economy in the US is growing. Right now, you've got a consumer who's still happy to spend and is going to have more money in their pockets because of tax refunds. Some of that will be offset because of higher prices. But, to a certain extent, you're looking around and you can easily paint a very bad picture around the US right now. But we still expect double-digit earnings growth this year, but more participation from the broader market. And I said, when you put those ingredients together, it should be a good year for US equities with some volatility thrown in. But as things evolve, we may have to adjust that assessment. And I think that's really important. We're managing the portfolio daily, right? We're looking at it, but we're buying for the long term. And some of this volatility will give us opportunities, and some will mean we'll have to trim some names sooner than we expected because maybe they've risen on some of these expectations as well. And I think that's really important, looking for the long term, because again, if this conflict disappears tomorrow, oil prices are going to come down because we started the year with an oversupply of oil. nobody expected oil prices to be higher. And so I think, that's been weighing on the conflict's been weighing on oil at the end of the day. But we do think normalized is lower. But, again, it depends on that market sentiment around what's happening. And that's what the market's weighing right now, if that helps.
Yeah, I think that's a really comprehensive answer. Thank you, Fiona. There's a question about valuations, and it's been a theme, hasn't it, in markets that at a headline level, US equities are highly valued, and this strategy kind of has a built-in way of dealing with that because the average is not the same as the individual valuation.
Mm-hmm.
But we saw a shift, I suppose, into European equities because of valuations versus the US. So with what's happened recently, where are we on average valuations, and then perhaps more specifically value opportunities and growth opportunities?
Yeah. And I would say you're absolutely right. The US tends to be a more expensive market. It's also a higher quality market. So for quality, you usually pay a little bit more. It is also the country and the region that's given you more earnings growth. We've definitely, you're right, seen a shift to Europe because they were able to produce 0% earnings growth last year, which was changed from being negative, right? It's the change, right? It's always about that change, that inflection point. But when we look to this year, the US has better earnings. When we look to the long term, the US has better earnings, but it's confidence in that earnings, right? Is that earnings number real? And so if you can buy this marketplace, even I would say at 20 times forward earnings and double-digit earnings growth, to me, that seems reasonable. And I would say at the end of the day, even in a US-led recession, the US outperforms other markets because of that quality bias. And so, one, I think it has to be an essential building block in anybody's portfolio. It's too big a market to ignore, right? If you look at a all country world index, the US makes up nearly 60% of it. So one, you do need exposure to it. I think that's really, really important. And it's a market that continues to grow. So why wouldn't you have exposure to it? And there's a little bit of a safety net. If we are going to go down the road of having a recession in a few years' time, whenever that time may be, the US typically outperforms other markets. And so when I put those main ingredients together, I would say, one, why aren't you owning the US? Even if you're just neutral, right? That's really important. But I would also say the winners of yesterday may not be the winners of tomorrow, right? So very often we see names that we love. For when I started in this industry, one of the go-to stocks was GE because it paid consistently a dividend, and nearly everybody used to hold GE. And that was good for that moment, but not for the longer term. So I would say don't get caught up in today, think about tomorrow. And that's what we do every single day. We're looking for those leaders for tomorrow, and we can find that across the spectrum of stocks in the marketplace. And so you see us underweight technology, and it's not that they're bad companies, but we think some of that better growth is coming outside of technology within the growth space, right? And we think a lot of the names in the value space, particularly in healthcare, are very underappreciated and that they have a lot of good earnings power that should get rewarded for that. And so I think having that nice balance is really important. And I think, that's where we're finding some great ideas within the portfolio. I would also say, some of the software names have sold off completely as if we no longer need software. I think what the market hasn't recognized is some of these companies are the building blocks for a lot of AI. They're going to be needed. And so we can do a lot of work in that space. So some of the software area that's sold off, and it's one of the cheapest areas of the market. But it does come with a bit of a health warning, right? Because not all these companies will survive, right? We've seen that time and time again. So our job is to dig deep with the research analysts, visit these companies, figure out why these companies may have a moat around them, why they may survive, and then think about them for inclusion within the portfolio. And so again, that hard work goes on every single day. So we're finding great ideas. And I think that's a really healthy part of this marketplace and dynamic that we're seeing at the moment in time. There's no let up in terms of ideas that we're looking at for inclusion in the portfolio.
Mm-hmm. There's a question about, I mean, it's specifically about Meta, but I think the reference is a bit wider in that there's been this ruling in California, and in the UK it's being reported as a really very important moment, and that there is a mood in the UK to regulate social media much more. How is that seen by the team, and how's it being seen in the US more generally?
Yeah, and I would say it's a universal mood, right? It's not just a UK or European. That there's more and more concern globally around social media. When we look at a name like Meta, in particular, again for us, it's for us the key for revenue has been digital advertising. If that gets impacted, we then need to go back and look at our earnings and how that transpires from there. Because they've been very good in terms of digital advertising and where they're going from there. And, with AI as well, it's definitely one where we think, one, the pace of change has been rapid, but also that they're going to leapfrog over each other, right? We had Alphabet's Gemini 3, which is far superior than what Meta has right now. And so that you've got that moment for them to do well. And then you'll probably see Meta come out with something else as well. And so when we're looking at both Meta and Alphabet, we had scaled back our positions over the last, we've added a little bit more to Alphabet, taken some from Meta overall. But we'll continue to monitor the situation, because when we look at it, it's all about the impact of future earnings and cash flow streams, and that the impact that that can have on any single business and a company doing the right things as well. So we'll continue to monitor it across the platform, across all our stocks that we hold within the portfolio. Having a deep bench, also having a sustainable investing team, having that engagement with companies on these specific issues is really important. And that's separate than engagements that we have on earnings. So that we can do a deep dive, get to the heart of the matter, really understand what they're going to do, how they're going to impact things and everything else. And that engagement is really, really important. And we've got over 60 individuals in our sustainable investing team globally who are tasked with this, undertaking work in this space in terms of having that engagement with companies. And it's something we've engaged with Meta about a lot. So it's not new news to us. We've engaged with them a lot in terms of what they're doing, what they're developing, what they're looking to do to really up their game to a certain extent in that area as well. And that's an engagement that will continue.
Well, 45 minutes just doesn't seem to be enough time to cover US equity markets, but we're bumping up against time. So there is a question which you can probably answer fairly quickly about share buybacks, and this trust uses buybacks and also issuance quite actively, doesn't it? So do you just want to go through what the approach is, what the objectives of doing that are?
Yes, and I think this is, one, the board laid out very, very clearly in their annual report in terms of what they're looking to do. It's a trust that really doesn't have a big gap out in terms of a discount, and I know some people will find that problematic because again, some people really like to buy trusts at a very, very big discount and hope it can come in. But if you look at the board manage that discount mechanism very, very nicely. They don't allow it to gap out too much. So they're very, very good at being active in the marketplace, which I think as an investor, I really like to see from that end in terms of managing that very, very well. So we are trading at a discount right now. So you're going to get another leg up in terms of hopefully that discount coming in over time. But they're also, again, very good at issuing when they can as well into the marketplace. So I think it's a board that works very, very well in managing that dynamic. And I think that's great to see.
Thanks, Fiona. Congratulations for the jam and sweetening the pie pun in the early part of the presentation. There are one or two other questions which we don't have time to go through now. If you want us to get an answer, please do get in touch. This presentation is recorded, and you'll also be able to download the slides. And of course, as ever, the JPMorgan American website contains a vast amount of information, and dare I say it, so does the Kepler website. So those are two very good resources to get more information. With that, Fiona, I thank you for dialing in from New York, and I thank everyone else for their attention, and we'll see you on Monday, hopefully.
Thanks for having me. Happy to come back as often as you need me, Alan. It was an absolute pleasure. And thanks to everyone for dialing in.